Today I'm going to cover interviews with different economists and money managers with their view of what is happening or going to happen in 2023 with both the economy and the stock market. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is Tuesday, January 17, 2023. I'll begin with an interview that Scott Wapner from CNBC does with Shannon Saccocia, the Chief Investment Officer of Silicon Valley Bank. She is holding the view that in the short run, stocks are going to pull back based on poor earnings data over the next 2 weeks. Take a listen.
Shannon, with you. And the question I asked at the top, risk reward for stocks, has it improved this week?
So I don't necessarily think that's the case. I think what we're looking at is that we have a kind of a show me environment, if you will, this quarter for investors who are really looking at earnings to determine whether they're going to be as bad as expected, or if they're going to indicate that the transmission of the Fed rate hikes in through the economy is likely to subside over the course of the next couple of quarters, or if they do believe that we are headed for a recession. You heard it at the banks this morning. There is clearly being priced in the potential for not only a shallow recession, but perhaps a more moderate recession by some of these banks. And so I think one of the challenges is that the earnings expectations have came down a lot in the fourth quarter, both for the fourth quarter, but as well for calendar year 2023. And how bad that is really where you're trying to determine if the market is appropriately priced. Now, that's not to say, Scott, though, that we don't have some opportunity here. But I think that if you're looking at just kind of anchoring to the CPI print, anchoring to some of the jobs data, for me, that's going to be offset over the next couple of weeks as it relates to earnings.
Okay.
Sara Eisen from CNBC interviews CitiBank's Ida Liu. Ms. Liu believes we will have a rough half of 2023 and that the market will probably move forward in the latter half of 2023, a view that I agree with. She points out that bear market bottoms are never hit until a recession starts, and that is still in front of us. Optimistic long-term and pessimistic in the short run. Take a listen to CitiBank's Ida Liu.
Joining us right now is Citi Private Bank Global Head Ida Liu. Ida, what are you telling your clients, your ultra-high net worth clients that are wondering whether this year is going to feel as rough as last year?
Well, investors have come off a beating last year where the markets took a $30 trillion hit. Global equities down 19%, global bonds down 16%. That coupled with the Russia-Ukraine war, 7 rate hikes, and obviously 40-year highs in inflation in June last year. So it was a really tough environment last year.
What is going to be so different about this year?
Well, we are projecting a recession, hopefully mild, in the first half of the year. And as you and I both know, bear market bottoms are never hit until a recession starts. So therefore, we think investors still need to buckle up for a lot more volatility and potential downside in the markets in the months and weeks ahead.
Next, I'm going to jump over to Bloomberg, and Bloomberg's David Westin interviews David Bianco. Even though we got favorable inflation numbers last week from the CPI report, David Bianco says that there is still an inflation fight ahead of us. The biggest issue is wages. They are still running red hot. The Fed will have to continue to raise rates, according to David Bianco. Take a listen.
CPI numbers encouraging on inflation. Is that what's driving the markets right now?
It is. And we knew that going into the week that investors would be focused on the inflation report. There were whispers that the inflation report would surprise to the downside. It didn't. It came banging on target. But it confirms that inflation is continuing to come down. However, the battle's not over. And I think investors should, and certainly the Fed will likely stay focused on the labor market. And we still see wages really running red hot. So the inflation fight's not over. We probably have a few more hikes ahead of about 25 basis points.
Next, David Westin continues with an interview of Larry Summers, who is the economics professor at Harvard and former Treasury Secretary. Larry Summers gives a balanced view of where we are now in the economic cycle and what that tells us about where we are likely headed. He cautions the optimists not to get too excited yet. And he also says it will likely be not as bad as the pessimists have expected. There is more damage ahead, but it may not be a doomsday scenario, according to Mr. Summers. Take a listen.
So we're joined once again by our very special contributor, Larry Summers of Harvard. So, Larry, great to have you back with us. And there's a lot of good news this week, I must say. Reopening of China. We've got a warmer winter than expected in Europe. Maybe not a recession over there. In the United States, inflation numbers are coming down. Are you rethinking some of what you said in the past about the likelihood of recession?
I think it is good news, and the evidence that there's been some wage restraint is part of the good news. But at the same time, I think one has to be careful of false dawns. And if you think about it, the good news was inflation running in the 6s, and that's still inconceivably high by the standards of 2 or 3 years ago. So I would stick with my view that a recession this year is more likely than not. But certainly looking at some of these trends, one has to think that the Fed's job is much, much closer to being done, feels much, much closer to being done in terms of disinflation than it did a few months ago. And I think the more optimistic possibilities, while they still would not be my bet, look more plausible today than they did several months ago. And that's got to be encouraging. We'll have to be watching the data very, very closely. And the most important day of this month, by far, from a macroeconomic point of view, will be the last day of the month when the employment cost index comes out. That's the gold standard measure of labor costs and wage pressure, and that's a number they'll be studying very, very closely at the Fed, and I suspect on Wall Street, and I'll certainly be up early that morning to get that number.
And finally, I wanted to give a macro view. When I say macro view, I mean over many years or even decades. So it's not, we've been talking about what's happening this year, maybe the first part of this year. Now we're going to stretch it out and look at a more macro view, things that are trends and things that are happening that will impact us in the future. He interviews Dr. Melissa Kearney, economics professor at the University of Maryland. Professor Kearney points out a macro trend in demographics. The fertility rates in the U.S. have been dropping for the past 15 years. We are clearly below the rate that is necessary to replace ourselves. This means a slowing economy and increasing debt levels in order to pay for the entitlement programs that we have signed on for. Social Security and Medicare are getting closer to the edge of the cliff, and fewer people are paying into the system, and more people are taking out of the system. Take a listen to Professor Kearney.
This is Wall Street Week. I'm David Westin. Every year, the Aspen Economic Strategy Group comes out with a monograph describing the state of the economy and, most importantly, what are the big issues that we face. They've just come out with their most recent edition, and we welcome now the director of that group. She is Melissa Kearney. She is professor of economics at the University of Maryland. So, Melissa, thank you so much for being back on Wall Street Week. This is a fascinating report from beginning to end, but particularly I'm interested in the part you authored, which has to do with fertility rates in the United States and what that could do for economic growth. First of all, give us a sense of where we are on fertility rates in the United States and whether this is a temporary thing or it may take care of itself.
Sure. So the U.S. fertility rate has plummeted for the past 15 years. And so the problem here is that now we are at a level of fertility in this country that is below replacement level. And so what's been happening is for 15 years, annual birth rates have gone down, and now we're at a point where the average number of children born to a woman in the U.S. is substantially below the sort of magic number of 2.1 that would keep us at replacement population level. It's now 1.67. My look at the data suggests that it's unlikely to turn around anytime soon. So what we've really seen is that the decrease in births is very widespread. It's coming from across demographic groups. It's coming across the country. It doesn't seem to be driven by any sort of sharp policy or economic change in the past 15 years. Rather, it seems to reflect more recent cohorts of young adults having fewer children or remaining childless more often than cohorts in the previous past. And so this suggests that there's been a general trend away from having children, from having multiple children. And if we look to other high-income countries that have been dealing with this for decades, it's probably going to be stubbornly low. That's my best guess.
So, Professor, here on Wall Street Week, we speak to investors in particular. What are the possible consequences of that in terms of economic growth? Because really, we have to depend upon future economic growth. What is that decline in fertility likely to do to us?
The decline in birth rates has meant a decline in population growth. And the most immediate effect of this is likely to be a shrinking size of the working age population. So the working age population in the US has been stagnant for over a decade now. And given the decrease in birth rates we've been experiencing for the past 15 years, in the not too distant future, we're simply going to have fewer people of working age. Now that's consequential both in a fiscal sense, meaning that it's going to put fiscal pressures on our social security system, funding for Medicare, disability insurance, but it also poses economic headwinds in the sense that you have fewer people of working age, and that doesn't necessarily just mean fewer people to produce stuff, lower economic activity overall. More worryingly, it could mean lower GDP per capita or a reduction in productivity per person, a reduction in living standards.
In the past, I have shown the Buffett indicator, which is it's a ratio. It plots the ratio of corporate equities to gross domestic product. Corporate equities being the numerator, gross domestic product being the denominator. And the higher it goes, the more it shows the valuations are elevated relative to the economy that supports those valuations, and vice versa. As it drops, then valuations are coming down relative to the economy itself. So this is a 70-year view, a 72-year view from 1950 to 2022-23. And this shows you can see it goes up and down a lot. And then there is a regression line that cuts through the middle of the data. I put in a couple of arrows here because I wanted to show you something. When we enter bear markets, a prolonged period of 10 to 15 years, and maybe even if you count the Great Depression, 10 to 20 years, where there is a long decline. It doesn't go straight down. It goes down, tries to go back up, and then it goes down again. And this is reflected both in the economy and in the stock market. I'm referring mostly to the stock market here. But I put these red arrows in here to show a couple of trends. One is from the late 60s up through the early 80s. So a period of 15 to 17 years that you can see on the arrow on the left. You can see the gradual decline, but it's not a straight line down. If you look at the blue line, which is plotting that ratio, you can see it goes down, it tries to go up, goes down, tries to go up, etc. And finally, it gets exhausted and it gets down to the bottom. Once it gets to the bottom and really, truly exhausts itself, and in this case, the market was down about 50%. And when it gets to that level, then it's finally ready to go back up, and you see what happened. Same thing happened in 2000 to 2008, 2009. The second arrow, it goes down more sharply, but again, there's the attempt to go back up, and then it finally collapsed because it had not exhausted itself. And once it had exhausted itself, not the first drop, but the second drop, when it got to that point, Then look what happened. That's 2009. Then the next 14 years, it went up. Not straight, but largely went up, including the exaggeration that went up during the past 2020, 2021, etc. And then at the very end, you can see where it dropped significantly. That's 2022. So that, just to put that in perspective, that's what 2022 looks like relative to the last 70 years. Now, we say, okay, yeah, that was pretty bad, but it didn't feel like it was horrible. It was not a crash. It was just a gradual decline with several head fakes that went on in between. But from this ratio standpoint, the valuation of stocks compared to the economy, it did come down quite a bit. And so, but it tells me when I look at previous patterns, they're all different. And if we went back further, we could see other patterns, and they are also all different. But one thing it tells you is they last a while. And they have periods like this where they go down quite a bit, but then they always go below the regression line, quite a bit below the regression line, and it takes at least a decade to get there. So what it tells me is, as I look at this, is that we will have periods of increasing value in the stock market of equities. That those could go for a year or two, maybe even 3, but for some period of time, and then it will collapse again because the damage has not extracted all of the pain out of the market that it usually does. So as I look out over the next decade or so, I would say we will have some opportunities to buy. Be very careful for head fakes, and we will have some opportunities to get out of the way. A buy and hold traditional model of investing is going to be very frustrating for investors during this period of time. It certainly was this past year. So I just wanted to put that in perspective, and I want to keep emphasizing this long-term view. Think out over the next 10 years, and what method of investing do you have to accommodate that, and how are you emotionally prepared to deal with that when you have, in some cases, half of your money ripped out of your hands? And I think that will happen. But so I think from my view, we're tactical managers, and so and we learned from 2022. It won't be perfect, but we expect to make money this year, and but we will be doing it tactically, getting out of the way when it's smart to get out of the way, getting back in when it's smart to get back in. And you can tell from the interviews that we just did that these people, money managers and economists, are saying that pretty much the same thing. 2023 is likely to be quite a mixed year. The CPI report, Consumer Price Index, came out last week, and this is what it looks like when you go all the way back to 2005. You look at the plotting the Consumer Price Index report, year-over-year data shows that it is about 6.5%. Well, 6.5% is better than 9%, but as you'll see, or as you heard from Larry Summers, it's still an elevated number. This is, by historic standards, going back to 2005 or even before. There were periods where it was higher, but they were short periods, and we're still at an elevated level. So from the Fed's perspective, from a monetary policy perspective, they are still forced to apply rate hikes. Most people agree that there's going to be a couple of rate hikes ahead of us, in order to push down the rate of inflation, they want to get it down to 2%. Okay, you can see 2% on the chart. That's a long ways down. So and they're very determined. They're not blinking on this one. They're very determined to get the CPI down to 2%, or even if you said 3%, somewhere in that range. So rates will definitely have to go up in order to push down inflation. Okay, when you take the rate of inflation and you break it apart, it's very interesting because there are contributing factors on both the positive side and the negative side. So the what has been pulling inflation up has been, this does not include housing. So we know housing is pulling it up, but food is pulling it up. On the last bar on the right, it's kind of color coded, and what's below the zero line is energy, gas prices. So we know that gas prices have come down. That's wonderful, and that is a contributing factor on the positive side for getting inflation down. And food and housing are stubbornly pushing it up. So the net effect was that the CPI report said 6.5%. This shows this is a month-over-month chart that shows going back to 2016. You can see the monthly changes month over month in housing prices. Housing prices are still nationally still high, and I don't know if they're softening. I see a lot of price reductions where I live from what the prices that people asked. So maybe it's slowing some. I would think because of interest rates it is slowing, but from a standpoint of rent, people who are renting their primary residence, prices are still pretty high. This shows the mortgage applications, and you can see that mortgage applications rise, generally speaking, in a period of falling interest rates, and mortgage applications decline during a period of rising interest rates. And you can see what's happening now is that mortgage applications have declined quite a bit recently, and of course that's a function of interest rates. I think the demand is there, but with interest rates contribute to the what people pay in a mortgage, and that's definitely showing up in people just not even applying. The Small Business Administration, NFIB, they have what they interview, they survey different small businesses, and they compile a composite, what they call an optimism index, showing the how optimistic small business owners are about the future. And you can see that that is negative. And small business, I mean, there's a lot of large companies, but mostly our country is run with a lot of small businesses. So, but they're fairly pessimistic about the future. And it's interesting to see this plotted over time. And let's hope that goes up. Okay, the manufacturing sector, the PMI report from the Institute of Supply Management shows the number of industries that are reporting growth. When you look at the top of the chart, there are 18 industries maximum that have, over this period of time, this goes back to 2005, so there are 18 maximum that have, one time it hit 18, that were experiencing growth. And in 2008, 2009, it went all the way down to zero. But here we are today, we're down around two out of, let's say, 18 potential that are industry sectors or industries within the manufacturing sector that are experiencing growth. Okay, flow of funds report. This shows where money is going, and everything had an outflow. So the conventional equity funds had an outflow of $16.3 billion, and bond funds had an outflow of $11.3 billion, and money market funds had an outflow of $8.9 billion. and speculation is that I agree with, probably it went into the reverse repo market. But it's interesting that all three of them are experiencing outflows. If you have questions or comments, leave them in the comment section below. I will answer any questions that you have. Thank you very much for watching.